The eCom Seller Summit was created to prove that with the right tools and training, anyone and everyone can make money in e-commerce. So many people want to try their hand at e-commerce, selling on eBay, Amazon, Shopify, and more, but they're afraid they won't be successful. This summit will show you that there's many ways to do e-commerce, and there are many platforms you can explore, because e-commerce really has no limits. It really can pay your bills, and e-commerce never sleeps. There's nothing like waking up to profits from getting sales all night long. My name is Nicole Whitlock, and this is the eCom Seller Summit.
Hello and welcome to the eCom Sellers Summit for 2022. My name is Lusundra Everett, and today we're going to be talking about business structures. It's what you don't know that costs you. So who am I and why am I here? I am here because Nicole invited me, and I'm always excited to be able to share with you guys. But I am the principal owner of Everett Tax Solutions. I am an enrolled agent, which means I am federally licensed by the IRS and the Treasury Department to prepare taxes and represent clients nationwide with the IRS. I'm a member of the board of directors for the Virginia Society of Enrolled Agents. I'm a member of the National Association of Enrolled Agents and also on the membership committee. I'm a fellow of the National Tax Practice Institute and a certified tax coach. I am a student of taxes. I have over 100 hours of continuing education per year. For 2021, I really topped out at 177 hours. So if you get nothing else from this, just know I am a complete tax geek. I have been selling on e-commerce since December of 2012. I've been on eBay, Amazon, FBA, drop shipping, and also selling on Etsy. I'm a mom of two. I'm a military spouse, specifically an Army wife, and I love music and movies. I'm a total movie geek to you guys. But please note that what is shared here is for entertainment purposes only. You really need to schedule a consultation with your tax professional. I am a tax professional, but I am not your tax professional. And you should be building a relationship with a tax professional if you have not. Okay, so we're going to cover all of these. It's a lot to cover in one sitting, so I really hope that you purchased the replay so that you can listen to this again and get all of this, and so you can soak it up and really understand what you need to know. But we're going to cover all of these business structures today: the sole proprietorship, the single member LLC, the partnership, the multi-member LLC, the S Corp, and the C Corp. Okay, so first we're going to be talking about the sole proprietorship. It is the simplest form of business. It generally requires you to have a business license from your local government, but really a sole proprietorship is you make a decision today that you are going to sell staplers, and voila, you are in business. Okay, there is no separation between you, the owner, and the business, which means that you can be held personally liable for debts and liabilities of the company. The owner is not an employee. I get this a lot. You as a sole proprietor, it's just tax law that you are not an employee, so you don't put yourself on payroll. You pay yourself by simply writing a check from the business to yourself or transferring funds from your business account to your personal account. The key here is to have the separation of the funds. And this, you file a Form Schedule C on the 1040 tax return that is normally due on April 15th. So as a sole proprietor, as far as tax filing goes, there is no separate business return. It's all a part of your personal return. And while I'm at it, one of the things that you will hear a lot in the streets is you want to separate your business from your personal. There is really no way to completely do that. Can you have separate returns and all of that? Absolutely. Can you have things in your business name versus your personal name? Absolutely. But there is always going to be a connection between you and the business. I don't care what type of structure it is. Okay. So, and the sole proprietorship is considered a pass-through entity. And a pass-through entity is when the profits and losses are passed through from the business to your personal return. So the sole proprietorship is a valid business structure. Don't let anyone tell you different, but just know that it is an additional schedule that is filed on your personal Form 1040. You can have a tax ID as a sole proprietorship. You can have employees as a sole proprietorship. It's just that you aren't one of them, okay? So that's the sole proprietorship. Next up is partnerships, where two or more people to an unlimited number of partners. There are huge conglomerates that are partnerships, okay? Now I have the asterisk here because depending on the state that you're in, if you live in a community property state, spouses can be partners, but you're still only going to file a Schedule C. So I just wanted to make that clear. So it really depends on your state whether or not you are married, if you are your spouses, to where you whether you would be an actual partnership or if you would be considered just one person in a community property state. So again, it generally requires a business license from the local government. There are general partners and limited partners. There are lots of times people say, okay, well, we're a limited partnership, but even limited partnerships have to have at least one general partner. And the general partner is personally liable for debts. Limited partners are limited in their liability, essentially based on what they contribute. But again, all partnerships must have at least one general partner. Okay, the partnership files a Form 1065 that is due March 15th. This is one of those things that gets people every time. Now, understand too that the partnership does not pay federal taxes at the entity level. For the states, it varies. Every state has their own requirements for the business, okay? But the 1065 does not pay federal taxes. Profits and losses are passed through to the partners on a K-1. So again, it is a pass-through entity. Now, partners earn guaranteed payments when working in the business, and you owe self-employment tax on that. As far as how much of the guaranteed payments is whatever the partners decide what the payments are going to be. So partnerships are similar to sole proprietorships in that it's just two people agree to go into business together. I highly recommend having a partnership agreement in place, and then you start business. But again, the key thing here that I want you to take away from this is that first of all, the due date of the return, also the failure to file penalty for partnerships. When you have a failure to file penalty for partnerships, that means that you did not file your return by the deadline and you did not request a 6-month extension, or if you requested a 6-month extension, you still did not file that return. The failure to file penalty for partnerships is $210 per month per partner. So if you have two partners in a partnership, in that partnership, you're looking at $420 per month until the tax return is filed, up to a year. So failure to file penalties can be really steep when it comes down to partnerships. So you definitely want to make sure that you file on time or file by your extension date. Okay, single member LLC. The single member LLC is disregarded at the federal level, but that does not mean that it is not a business, okay? It just means that the default is to be taxed as a sole proprietor, and it follows the rules of the sole proprietorship, except that the single member LLC gives the business its own identity, right? Whereas a sole proprietor, you and the business are one. As a single member LLC, that gives the business some identity. And that's really more of a legal concern than it is a tax concern, right? Because you get the same tax breaks with a sole proprietorship as you do with a single member LLC. It is all the same. Your tax return looks exactly the same. So it files a Schedule C with the 1040. And you're registered with the state at the state Secretary of State website. And it's a state-run entity, and so you have to follow the rules for your state. Every state requires something different, every different annual fee, different annual reporting. So you just have to know the rules of your state. And I will tell you this about the disregarded entity thing, and especially if you go to a DIY site to form your business, there are some of these sites that will tell you, okay, great, you formed your single member LLC. Now you have to choose a tax classification. Well, a single member LLC is just fine. You don't have to go and elect other taxation just because it's a disregarded entity. But the only thing that disregarded entity means is that the default is to be taxed as a sole proprietor. That's all. Multi-member LLC. Do you see a pattern? Okay, so the multi-member LLC is just like a partnership, but with an LLC. Again, 2 or more people. When you have spouses, if you're in a community property state, you have a little bit different rules than spouses who are not in a community property state. So again, you can have unlimited members. Now, in a partnership, you have unlimited partners. In a multi-member LLC, you have unlimited members, okay? Again, it's a state-run entity registered with the Secretary of State, files an annual report. The default classification is a partnership, files a Form 1065 due March 15th, follows the exact same rules, and does not pay federal taxes at the entity level, but you may owe at the state, okay? So you have to know the state rules. And profits and losses are passed through to the partners on the K-1. The same failure to file penalties also follow the multi-member LLC. So the multi-member LLC is just a partnership, but it's an LLC instead. Now, also with that, you still have to have a general partner in the multi-member LLC. It has to be at least one. You still have to follow those same rules. And so with the profit and losses, they're passed through to the partners on the K-1. We still have that pass-through entity going on here. Okay, next we're going to talk about S Corps, also known as the S Corporation. So S corporations can have only 100 shareholders, okay, and spouses count as one shareholder. All shareholders must be a U.S. resident or resident alien or green card holder. Now, let me explain what that means. Because spouses are considered one shareholder, if you are a single person and you have an S Corp, and you marry someone who is not a U.S. citizen, then suddenly you lose that S Corp status and you revert to being a C Corp. Okay, so this citizenship thing really does matter. Okay, the owner of the S Corp must be an employee of the business and take a reasonable salary. That is the tax law. That's the rules. It's not optional. The S Corp does not pay federal taxes. It's essentially an information report. Now, again, the state requirements vary. There are some states that do not recognize S Corps and you must file as a C Corp. There are some states have franchise taxes. There are some that have a minimum tax. There are lots of different rules for different states. So you've got to know what your state rules are for the S Corp. File the Form 1120S as in Sam, as an S Corp. And that's due March 15th as well. Profits and losses are passed through to the shareholders on the K-1, and there is no self-employment tax on distributions. So let's talk about that for just a moment. So with the S Corp, the owner of the S Corp is on payroll, okay? And those wages are a deduction to the business. Now, after the business pays all of its expenses, including the salary, whatever is left over as profit is then distributed to the shareholders. And so on the personal return, there's no self-employment tax. So think back to the Schedule C, where it's a single member LLC or sole proprietor. You're paying self-employment tax, and most people know about that 15.3% self-employment tax. And so most people form S corps to try to save on that self-employment tax, okay? But there's an upside and a downside to that. So with the self-employment tax, that is Social Security and Medicare for the self-employed, okay? And when you pay yourself a salary, you are also paying into the Social Security and Medicare system, okay? Now, if you lowball yourself on your S corp salary, then you're lowballing yourself on your Social Security later on in life, if it's there when we get there. It's not, it's something that you need to know so that you can plan for those things, instead of getting to that age where you're drawing Social Security and you're wondering, like, why is my Social Security so low? Well, it's going to be based on what you paid in. Okay, so just understand that when you're choosing that reasonable salary and, you know, taking those distributions, you're not paying Social Security and Medicare tax on that, right? You're not paying any of that tax on that money. It's what you pay in your salary that goes to Social Security and Medicare. So that's why this is an S corp is really something that you got to know what you're doing when you elect S corp treatment. Okay, C corporations. Now, C corporations became really attractive during the Tax Cuts and Jobs Act of 2017. And the reason it became attractive is because the corporate tax was changed to a flat 21%. And for a lot of people, that sounded really good, except that most people weren't paying 21% anyway. Okay, so before you go jumping into C corps, you need to know what your effective tax rate is to begin with. Because what happened is that a lot of people said, ooh, flat tax at 21%, awesome. And they went to form the C corp, but then they wound up paying higher tax because they weren't paying that 21% anyway. Okay, so in the C corp, you can have unlimited shareholders. U.S. residency is not a requirement. Now, if you are an owner who works in the business, you must be on payroll. The C corporation is the only business structure that pays its own federal and state taxes separate from the individual. So if you own a corporation, it is possible to owe in your corporate tax and owe on your personal tax. It's also possible to owe on your corporate tax and get a refund on your personal tax. It's possible to get a refund on your corporate tax and still owe on your personal tax. These are two separate entities. So when people are talking about separating their business from their personal, they're generally talking about a C corporation, because a C corporation is the only business structure that really stands on its own. There's no pass-through from the corporation to the owner or the shareholders. So shareholders will pay taxes on dividends when it's issued from the corporation. That's a 1099 DIV. The Form 1120 is normally due on April 15th unless there's a fiscal year. And if it's a fiscal year corporation, you have to get approval for that, and you got to have a really good reason for that. The shareholders generally cannot be held liable for the wrongful conduct or liabilities of the business. Notice the word generally, because if the investigation is that shareholders acted inappropriately in a corporate structure, or if you commingle corporate funds, suddenly people can become personally liable for wrongful conduct and liabilities of the business. Profits are taxed and dividends are taxed. This is the double taxation that you hear about. So even if you were a single owner corporation, you could have a tax bill as the corporation. You can have dividends distributed from the corporation to yourself, and then on your tax return, you've got to pay taxes on those dividends again, because dividends are not a deduction for the C corporation. So the C corporation pays taxes on those same dividends, and so does the shareholder. That's that double taxation that you hear about with C corporations as the downfall. Okay. So with all of this, the main thing that I want you to take away from this is when it comes down to business structure, there you really need to consult with tax professionals. You need to consult with attorneys because there are legal concerns with business structures as well as tax concerns, and they're generally not the same thing. So what will cost you in taxes may save you legally, and vice versa. So you really have to know what your goals are when you're talking about business structure. What is the purpose of the business? How do you plan to run the business? If you're going to take on shareholders and that kind of thing. All of those things determine whether or not you should have a particular business structure. Even in e-commerce, even as resellers, you can still have a corporate structure. It just has to make sense for you to do that. Okay, so I really want you to take that away from this presentation. So the questions that I get all the time is, when should you do this? When should you do that? So the first thing is when should you have an LLC? That depends. It depends on the nature of your business. Can you be in e-commerce and have a sole proprietorship? Yes. Do you necessarily need an LLC? Not necessarily. It really just depends on the nature of your business and what your goals are. So if you plan to keep it small, which some people do, then having a sole proprietorship may be just fine. But if you are really planning to go and boss out, which if you're on this summit and you're hanging around Nicole Whitlock for 5 minutes, that's going to be your goal. Then having an LLC may be a better option for you. Not that you have a legal concern, but because LLCs have the flexibility of being taxed in different ways, right? And so with having an LLC, you have the option of starting out being taxed as a sole proprietor and then moving into being taxed as an S Corp. And you can even move into being taxed as a C Corp from an LLC. I liken an LLC to a business on training wheels. You just grow out of a single member LLC at times. But as far as like when you need it, it totally depends on the nature of your business and what your goals are for the business. And in some states, having an LLC can be cost prohibitive. Like California, for instance, you're going to pay a minimum $800 to have your LLC. And so you have to make sure that your business can cover your expenses. Okay. So there's no one right answer. My favorite, of course, is when should you elect S Corp? Well, that depends. And it depends on several factors. And the fact is there's no one right answer for everyone. Like I said, you'll go on these DIY sites and they'll tell you that you have to choose how you're going to be taxed. And again, that's simply not true, because what happens is on our end for tax professionals, we get clients who are S Corps way before they really need to be. And electing S Corp treatment before you really need it will cost you more than what it's worth. And so that is something that you really need to consult with a tax professional about to see if and when it will save you on your self-employment tax. Because that's the reason that people really elect S Corp, is to save on self-employment tax. And just as an example, I had a client come to me, and she was a new client, very upset that the previous person did not submit her S Corp election. And so I reviewed her returns and I asked her, like, why did you want to elect S Corp? And she's like, well, I want to save on self-employment tax. I'm like, well, you don't have any self-employment tax because you have a loss. And so had she elected S Corp too soon, then she would have had all of this additional administrative stuff and is not necessary. So you really want to make sure that it's really going to be worth it to you. Okay, it's got to be, your tax savings has to be worth all of the administrative costs, because you have to have proper bookkeeping in place. You have to have payroll in place, and you have additional tax returns to file. You have additional employment tax returns to file. So there's a whole lot of administration that goes along with having an S Corp. And that when people are telling you, these DIY sites are telling you that you have to, select this tax treatment, they're not telling you that part, because the assumption is that you're supposed to already know what you're doing. Okay. So again, I've gone on like to great lengths about this S Corp, but just understand that there's no one right answer for everyone, because it just depends on so many different factors. The next one is, when should you become a C Corp? And again, that depends. It depends on all of the factors we just said. It depends on whether or not you're going to have shareholders. It depends on, is it going to save you in taxes? Does it offer you more benefits than the current structure that you're in? So just know that when it comes down to business structures, sometimes the answer is easy, sometimes it's not. You really need to invest in the consultation to figure out what's going to be the right thing for you, both legally and financially. And so now I want to talk about IRS enforcement. Like, what's going on in the IRS that you need to know as a business owner? Okay, so every year, the IRS pretty much tells us what they're going to be doing, what they're looking for. And right now, the IRS is looking to increase enforcement efforts to reduce the tax gap. The tax gap is the difference between the amount of taxes owed and what's actually paid. And right now, we have a very huge tax gap. If you think about the past few years over the pandemic, we have, as a country, have paid out a lot of money, helping businesses stay afloat, helping families stay afloat with stimulus payments. So there's a lot of money that went out. Okay, now we got to get that money back. And so that is where the IRS enforcement becomes in, because now they're looking for people to pay their share of taxes, what they owe. So first thing they told us is that the Schedule C audits were going to increase by 50%. And if you know anything about audits, here's one thing that I'm not sure many people know. When IRS auditors are being trained, they are trained on the Schedule C, because there is so much fraud in the Schedule C. There are tax preparers who will actually file a fraudulent sole proprietorship business in order to get their client more money back in a refund, right? So that's where auditors cut their teeth, on the Schedule C. So they've already told us that Schedule C audits are going to increase by 50%. The S Corp, they're starting to audit for basis, okay? So basis is generally the amount of money that you put into a business. So if I start an S Corp with $1,000, I have a basis for $1,000. Now, what happens when you get distributions is that when you get distributions, that basis part, that's not taxable. It's when you have distributions in excess of basis that it becomes taxable. Well, now the IRS is going to be auditing for basis to make sure people are paying their taxes correctly from their S Corp. And they created this brand new form called a Form 7203 that is going to be filed with your personal return. It's not filed with the S Corp, but it's filed with the personal return, because at the end of the day, the shareholder is responsible for tracking their basis. And that's what the Form 7203 is designed to do. Partnerships. One of the areas that they're looking at for partnerships is foreign tax evasion. That's for people that have foreign interest, whether they have interest in foreign stocks, foreign business. And the IRS came up with forms K2 and K3, and these forms are 29 and 30 pages respectively. These are some long forms. They implemented this for 2022, but they did it with some options to not have to do it. So, but it's a new form, so it's really not going to impact a lot of people for 2021, but for 2022, when you're filing in the following year, that's going to be an issue. And they're going to be looking at, if you as a partnership, if you have, is not only does the partnership have foreign interest, but do the actual partners have foreign interest. And so that's going to require the tax professional that's preparing the partnership return to know that information about each partner. So it's going to get a little complicated going forward in filing these returns. One of the things that I did not put on here and completely forgot about was the 1099K. So for starting in 2022, reporting in 2023, the IRS changed the reporting for the 1099K. It used to be that the 1099K third-party reporting was for 200 transactions and $20,000. You had to cross both of those thresholds for third-party payers to issue the 1099K. And your third-party payers are like your Amazon, PayPal, Stripe, even QuickBooks, right? Those are all third-party payers. And so now those that threshold has been reduced to $600 across the board. Now, some states had already reduced their requirements to $600, like Virginia, Massachusetts, and I do believe Vermont had already made that adjustment. Now it's happening at the federal level. And one of the things that it really upset people is that they thought that now they were going to be being taxed on money that they should not have been taxed on before. And that simply was not true. It's just the reporting was different. You were still required to report your income, even if you did not get a 1099K. However, people weren't doing that. And so now the IRS Congress has changed the law to require reporting at $600 or more. And the other thing with the 1099K is that knowing that if you pay someone in cash or check or direct debit, those things are considered cash, and you need to issue the 1099 NEC, the non-employee compensation. If you paid them with a credit card, or if you use Stripe, or if you use PayPal, then those third-party payers issue the 1099K. You don't issue the 1099 NEC, okay? Because what happens is an issue with double reporting. So I just wanted to make sure that you knew that. I'm sure you'll be seeing more about it, in the news and whatnot. But just know that the 1099K reporting has changed. It's been reduced to $600, and that's going to be when you file your taxes in 2023. Okay, so corporate elections, the FAQs and the answers. Street committee tax advice is generally wrong. So when you see stuff on the internet, and we see it all the time, all of these gurus out here, these seven-figure earners giving you all of this tax advice on what you can do, how you can save on taxes, all this, generally it's wrong. Okay? It's generally wrong. So when you see something like that, before you go and implement what they're saying, you definitely need to check with your tax professional. Schedule the consultation, okay? It's worth the money. Okay, so the yeses. Yes, LLCs can make an election to be taxed as an S Corp or a C Corp, but you don't have to, okay? You can do it when it's the right time to do it. Yes, LLCs, S Corps, and C Corps can limit liability. But again, we talked about that commingling. You have to keep those business funds separate from your personal funds, because in the event of litigation, if you have commingled your funds, then all of your liability protection goes out the window. I don't care how fancy your structure is and all of that stuff. If you're commingling those funds, if you get sued, then all of that limited liability goes out the window and your personal assets can be attached. Yes, there is a cost to compliance. That is just the long and short of it. Compliance costs. You have to have proper bookkeeping. You have to have payroll, and you also have the additional returns. Now, listen, with this bookkeeping thing, bookkeeping is the foundation to it all. And especially as you get into the more complex business structures like the S Corp and the C Corp, when the IRS is tracking your basis and all of those things, that is a bookkeeping issue. So if you do not have proper bookkeeping in place, that is going to cause you more problems than the bookkeeping expense ever will. Okay. And yes, you need to seek competent tax and legal advice before making an election. People reach out to CPAs all the time. There are CPAs that don't do tax. I've seen some CPAs and attorneys recommend business structures that just kill you tax wise. And so that's why I say you have to do both. And as tax professionals, we can tell you how something will impact you as far as your taxes goes, but as far as legal advice, we can't do that. So that's why you need both tax and legal advice before making an election. Do not confuse legal concerns with tax concerns. They are really two different things. So no, forming an LLC does not get you more tax deductions. If you are a sole proprietor and you're forming an LLC just for tax deductions, you have done nothing but created an additional bill for your annual filing for your state. Forming your LLC in another state does not save on taxes. Your tax is based on where you live and possibly where you do business or have employees, okay? So if you're thinking about forming an LLC in Nevada or Delaware or Wyoming and you don't live in those states, it's only going to cost you more because you still have to register as a foreign entity. Foreign mean not formed in your state, in your home state. So you don't get to avoid paying your state taxes, okay? You generally don't get to completely separate your business from your personal taxes. That's just the way it is. You have all of the pass-through entities, the S Corp, the partnership, the multi-member LLC, the sole proprietorship, the single-member LLC. All of those are pass-through entities. But even at the C Corp, even though that income is separate, your name and social security number are still attached to those business structures, okay? Not everyone needs an LLC to get started in business. You just don't. It just really depends on what you're doing. Even in the e-commerce arena, if you're private labeling, you definitely want to have an LLC. I think there's an increased risk for litigation when you're private labeling. So you definitely want to have that legal protection in place. But if you're drop shipping or if you're reselling books, 9 times out of 10 you don't need an LLC. You may want to get one for if you have future plans depending on what you plan to do with your business, but you don't need one to get started. No, you can't just issue yourself a 1099 NEC from your corporation, from your S Corp or your corporation. You got to be on payroll. I generally never recommend starting out as an S Corp or a C Corp. And I say generally because there are people that have special circumstances. There are corporations, there are businesses that need to get funding. And depending on where you're applying for your funding, they may require you to have a certain business structure. But just on a regular day, I generally never recommend anyone starting out as an S Corp or a C Corp unless there is a specific reason for doing so. Saving on federal taxes does not mean you'll save on state taxes. The thing about tax, federal tax is the same across the board in all of the states. It doesn't matter. But because we have all of these different states, all of these different states have different state tax laws. So even though you may save on your federal taxes, that doesn't mean that you're going to save on your state tax requirements. There are some states that really have hefty filing requirements for the LLCs and corporations and whatnot. So just know that when you're looking at tax savings, you got to consider the state as well, and not just the federal self-employment tax. Okay. So that was a lot. I covered a lot in this short time. The main thing that I want you to take away from this is that you can't just watch a YouTube video. You can't just go on Google and figure out what's right for you. It really takes a consultation for you, to discuss your business plans with someone who has credentials in that specific thing. So even though you have these sites that allow you to form these business structures on your own, it doesn't mean that you should do that all willy-nilly. That's the point I'm trying to make here, and I hope I've made that crystal clear. So by contact, you can schedule appointments at homebiztaxchat.com. You can schedule business consultations. You can also schedule a discovery call, but my calendar does fill quickly. So if you don't see a time that works for you, shoot me an email and then we'll try to find a time. You can find me on YouTube and Facebook. Mostly, I pretty much live on Facebook. I'm not even gonna lie, y'all. So when people can't get me on my email, they find me on Facebook. That's how bad it is. But I'm also on Instagram and Twitter and on LinkedIn as well. And I'd love to have you connect with me and we get to know each other and know more about your business. So thank you guys so much. I know this was a lot. I hope you purchased a recording, because if for nothing else, this right here that I shared with you will really save you, because if you get into these business structures all willy-nilly and you do it wrong, it's going to cost more to fix than if you would have just scheduled the consultation. Okay, so thank you guys so much. Enjoy the summit, and I will see you in the group. Have a fantastic day, you guys. Bye-bye.